as 2008, the reasons for it are very different. They are not driven by any sort of fundamental problems that we may see in our own economy here, but rather by investor concern on the global economy on a general scale. Does that make sense? Okay, let's continue. This is a chart that we show. Let me explain this chart, and then I'm going to take your question,
okay,
sir, if that's okay. This is a chart that we usually show to explain what the Fed is saying of where they're going to move that key lending rate, the federal funds target rate that I mentioned earlier. We can basically throw this out right now because of the events of the past few weeks. The general consensus now is that the Fed will likely wait longer than what this chart is telling us. So they're not likely to move. People are focused on when are they going to raise rates? When are they going to raise rates? Well, we don't think they're going to. Initially, the thinking was September or December. Now there's more thinking that maybe December or further on. Sir, what is your question? Yes.
It wasn't a question, it was a comment. What's happening over there is that the government of China has devalued their money. It is not functioning in the marketplace. And the investors are nervous because they don't know what the Chinese government is going to do, whether they're going to lower it again to devalue it and to try to make their exports cheaper. But it also helps us with when they devaluate their money, because
we
it makes our dollar
goods
stronger. Pardon me?
We could certainly afford more of their goods
Yes.
when they devalue their money. And to your point, China to some degree is still a centrally, not fully centrally planned economy, but there's a bureaucracy that plans the economy there. It really does. And it's less market driven than ours is. And indeed, what you just stated is part of investor concern. That's one of the things they're focused on. Absolutely. All right, let's go on past this chart and past this one too. So let's go back to our economy here and what's driving the markets, and certainly what drove your portfolio and the results over the past couple of quarters, or this particular quarter. What I'm showing you here is the growth of the United States economy. GDP, gross domestic product. It has four components, four broad components. They are consumer spending, government spending, business investment, and then net exports. Those are the four components. Basically every economic activity in the United States falls under one of those four categories. They're consumption, government, business investment, and then net exports. And out of all of those, the biggest one, the engine of our economy, unlike China, is consumption. It's consumer spending. It's all of us going out and buying the things that we need to buy. That's 70% of this number. Okay, that's 70% of this number. So you can see that China right now is in the midst of a dislocation, and they are trying to move to an economy that's less export driven because of the cheap labor and manufacturing that they have, and more of a consumption driven economy. How long that's going to take, what that's going to look like, we don't know. But it's certainly going to have the effects that we've seen over the past couple of days. Now, here in the United States, I want you to notice that for the first quarter, these are quarterly numbers, and they're given quarter over quarter, the change from one quarter to another on an annualized basis. So this is annualized growth as we see it change from quarter to quarter. And you can see that for the first quarter of 2015, the number was lackluster. Honestly, we don't like to write home about it unless we're looking at 3% or above. And you can see that the numbers for the last couple of quarters have not been there, and that's not great. But the good news about this is that 0.6 number that you see for the first quarter, that was actually initially a negative number. The Bureau of Economic Analysis, which tracks these numbers, actually had this down as a negative 0.2, as a contracting economy. When they revised the numbers, as they do seasonally, it looked like we indeed grew, which is good news. And the 2.3 number is an initial number and likely to increase. Why is this number up? Why are we growing? Well, look at real estate. We've seen a pickup, even if it's driven, whether it's driven by speculators, which certainly there's a good number of those in the real estate market, or you're seeing buyers with pent-up demand. I see less pent-up demand than it is more speculation. But you're seeing now real estate prices starting to reach pre-recession levels. Okay, certainly in the greater LA basin, they're already there. And in the Bay Area, they're already there, and above. Okay, so that's one of it. There's a wealth effect associated with that. If that's the biggest asset on your personal balance sheet, you are likely to spend a little more, and that drives the economy. That's one reason. Another reason is simply because we have lower inflation think cheaper oil, which basically leaves more discretionary spending in your pocket at the end of the day. We have lower unemployment, even though that's a mixed number, and I'll get to that in a moment because there's some caveats that come with that. We have lower unemployment. We have higher job creation, which has been steady for the past several quarters. All these things have driven growth in our economy, which the Chinese are in envy of, quite frankly, right now. Let's go to the next slide. Here's that unemployment number that I mentioned. The red line as measured on the y-axis on the right-hand side. You can see that it's fallen down to 5.3%. In the last quarter, we created 664,000 jobs. In the month of July, I think it was 221,000 jobs. Anytime you're creating over 200,000 jobs a month, you're in good shape. That's good news. The only negative, there's two negatives about the employment picture, and they are that wage growth is still stagnant. You're not seeing a lot of wage growth, partially because some of the jobs that we're seeing in the economy are not jobs that pay they're not full salary jobs, they're more seasonal or part-time, and that factors into it. That's one of the reasons. The other reason why there's a caveat on this is because we still have a very low participation rate. Those people who are eligible to work, those that are eligible to work that are actually working, that number is the lowest it's been in many, many decades. So it just kind of makes people pause and think that perhaps you might see a lot of people come back to the market to look for work, which might drive that red line back up, which we don't necessarily want. But for now, we do have job creation. We have 5.3 unemployment. Good. Consider what it looked like at the height in the belly of the recession, 10% unemployment. So we've whittled that number away. I want you to remember that when we show you returns in the portfolio, we show you what's called a total return. And that means that, think of the two ways that you can drive return in a bond portfolio. You can collect interest income because these are interest-bearing securities. They pay you interest periodically. So you can earn interest income, A, or B, the value of the principal can go up and down. It can shift, okay? So when we show you returns, it's a periodic return. It's a look back in time, and it shows you the return from point A to point B, combined interest income and market valuations. So you can see that for the past quarter, it was only 8 basis points. It was a bit of a lackluster return for that 3-month period. And the reason for that was, well, you earned a good amount of interest income. That worked out well. In fact, when I look at the yield to maturity of the portfolio, just a column to the left of the past quarter number, 86 basis points is a strong yield for a portfolio which averages less than a year and a half. In fact, you're at a year and a quarter. That's that duration number right there. That's a very competitive number. 2-year yields, we said, were in the 50s, 57 basis points. You're earning 86. You're shorter than a 2-year portfolio. So the interest component is doing well. That's no problem. You're getting interest income that's coming in. The negative of that quarterly number is that I mentioned earlier that yields from March through June did go up, and that devalued the portfolio. So when I blend the market value component and the interest income component, I blend those two together, I get those 8 basis points, and that's what we're getting our number. But again, if I look at what interest income you're going to earn for the coming year, if nothing in this portfolio changes, 86 basis points in this environment is a very competitive number. When you look at since inception, which is March 31st of 2012, so we've been at this since the end of the first quarter of 2012, you've been averaging a little bit over 1% per year. Consider that during this time period, we had yields in this maturity range that were in the 35, 25 basis points, like a quarter point less. So you've done okay. You've done okay. Now, if we go to the next page, remember, look at the past year, 83 basis points. That's what you earned for the past year. If I go forward, thank you very much. If I go forward, I'm just going to focus on, so the top, look at the blue line at the very top, and I'm going to focus on the 3-month and the 1-year number for that 1 to 3-year indices, U.S. Treasury. Effective duration of 187, you're at 127, yield of 63 basis points, that's the interest income to come for the next year, you're at 86. The 3-month number was 15 basis points, okay, you earned 8 basis points. The 1-year number was 88, and you earned 80, what did we say, 86 is what it was? Okay, so you are more conservative than that Treasury index in terms of your average maturity. Okay, so it would stand to reason that your return would be somewhere south of it or near it, and indeed it was. One of the things that we did notice during the quarter is that I mentioned to you that yields rose and the values of the underlying investments went down during the quarter. Well, you carry a very well-diversified portfolio of securities. It includes high-quality corporate securities. Well, during the quarter, those high-quality corporate securities actually devalued a little faster than the treasuries did. And that's why you're not beating that benchmark there. That and the fact that you're much shorter than it. If you look at the one-year index, it's interesting that the one-year number, just look at the one-year index, it says 1 to 5 year indices, U.S. Treasuries. If I look at Treasuries and just go across to the one-year column, the return for that was 138. The 1 to 3 year was 88. Everyone see that? So the key thing here is that over the past year, being longer, so those investors that had longer strategies and bought the longer bonds, they actually did better than the shorter, even though for the quarter, being longer for that 3 year period was actually worse than being shorter. And as evidence, you can see here the negative numbers that we see over here as you go down. And in fact, this is lower. This 2 basis points lower than the 15. You can see that the 3-month number, longer was worse than shorter, but for the year, longer was better than shorter. I want to highlight that because we may be entering a rising rate environment which would devalue these investments. We may see a sustained period of time that will look like the 3-month numbers, rising rates, and we're going to have to monitor that loss in value. We're going to have to mitigate that loss in value by additional yield, and it's a balancing act for us because we can pick up additional yield in longer securities. That's just the way that it works. Let's go to the next one. When you look at the portfolio holdings, a very well-diversified portfolio, that's always a good thing. We did reduce the commercial paper component, that's short-term unsecured corporate debt. We did increase the negotiable certificates of deposit, that's a good thing, those carry a higher yield. We did pick up a little bit more in federal agencies that we're allowed to buy, and that came at the expense of the treasuries, but very well-diversified. In fact, if we go to the next page, you can see the breakout in terms of the corporates that we hold. We not only do we diversify from a sector standpoint, but also from an issuer standpoint. And the names that you see up there, those that are other than treasuries and federal agencies, are very high credit quality corporate names. They're household names. Some of these don't even need to issue debt. They issue debt because it's a tax play. That hasn't ended yet. It might sometime maybe if we have a new administration, we don't know what that's going to look like. From a credit quality standpoint, it continues to be very high credit quality. And if we go to the next page, you can see that the portfolio has been getting just slightly shorter on average. So you can see what the gray bars show you how much we held in these maturity ranges last quarter, and then the blue is where we hold them today. And you can see that the portfolio is generally aging in, and that's just a function. We were given a directive by the board to take a little bit more of a conservative stance because of that concern of rising rates. So we're not allowed to make any new investments in investments that are longer than 2 years. So we've been following that directive. You've given a little bit of return, but in turn, of course, you are a little bit more conservative in the markets, and if rates continue to rise, that's not a bad position for you to be in. Let's continue to the next one. I'm going to let you read this one, but I will just summarize it by saying these couple of things. The big shift now, when I think of back in 2008, what happened in the bond markets is that investors ran for the doors looking for safety. It means that they bought treasuries like they were going out of style, which drove their yields down to these record levels where we are today. That's why yields are still so low. Investors bought them up and drove those yields down, that in conjunction with the Fed lowering the federal funds target rate. That's why we see it was a rally. When we saw those yields fall so dramatically, the values of the portfolios went up dramatically. Okay, the yield, the interest income component, think of those two components of return. The interest income component went down because yields were falling, and as you reinvested in lower yields. Okay, but the values went up. Well, in the coming quarters, in the coming 6 to maybe 18 months to 2 years, the opposite of that is going to happen. We're going to see a rising rate environment because of the forces that I mentioned. Maybe not after today, not after yesterday with the China debacle and what's happening there, perhaps a little bit later down the line, but it's going to come. the Fed has to raise rates at some point, and we need to see rates get normalized a little higher, and it may take a long time. But when we see that, the opposite of 2008 is going to happen. It means that valuations are going to be under pressure, but the interest income component is going to go up. That's a good thing, because the interest income component is an actual, it's spendable money. It's money that goes directly to your budget, and it's spendable. Though you book it from an accounting perspective, you book the entire thing. I know that Teresa books the market, she marks the market on a periodic basis. But from a budgetary perspective, you're going to see this be a little bit additive to your budget. The kind of return that the agency wanted to achieve, and at the same time, the kind of risk that you were comfortable with over a long-term period. We've always had a bias that you could enhance the return over a long-term period by sticking to that. But the desire of the board was that you didn't want to do that. You really wanted to limit it to 2 years and in. That's worked well. It certainly will work well in the short term. But our bias has always been you should always revisit that decision and consider what going out to the full board of investments, the full maturity range that you initially started doing might do to your portfolio over a long-term period. You're giving up a little bit of return, but of course, in return for that, you're getting the comfort of a little bit more of a conservative portfolio. To answer your question, we always just bring up, hey, let's look back at the longer-term investments, longer than 2 years, because you might be able to enhance the return. And we've posed it before, and the answers always come back, we're okay where we are, which is fine. It works, and it's worked well for you.
How many years have these funds been in?
Since March 31st of 2012.
And they have grown from 25 million to just shy of 25.8 million in that time.
Any other questions?
$80 charge or cost reimbursement charge related to a condemnation matter, and I think the committee was just curious what that was. It had to do with a condemnation lawsuit filed by the Los Angeles Department of Water and Power that was seeking right-of-way for a renewable transmission line, and AVEK had been named in that lawsuit because their title search revealed that AVEK had an interest in a temporary construction easement that went back a couple of decades. And since the easement had expired, then the appropriate thing to do in that circumstance is to file a disclaimer, and that gets rid of it without having to suffer a default. So we filed a disclaimer, and $80 was just a filing fee in court for filing a disclaimer. That's what that was.
Thank you.
Since then, there's been another lawsuit related to the same project, which AVEK was served with on August 7th. And that involves an AVEK interest, which is more important to the agency. This is the City of Los Angeles Department of Water and Power renewable transmission lines. So these are overhead transmission lines that are bringing renewable energy down from Northern California down into the city. I'm not sure where it originates, to be honest. I think it's called Kern Renewable Energy Transmission. You're probably more familiar. Anyway, it crosses over the agency's pipeline right-of-way on Gasco Road, and that's right-of-way that the agency acquired and owns in fee. The lawsuit seeks to condemn where it crosses. There's a stretch of pipeline right-of-way. The lawsuit, the way it's pleaded, seeks to take the agency's fee interest. They want to condemn it in fee themselves. And so obviously that's a problem. The lawsuit was filed on August 7th. There's a 30-day period for filing an answer. When we took a look at the complaint, and given the shortness of time, had to do a quick conflict check in our firm, and found out that we've got some lawyers that are working on City of Los Angeles matters that created a conflict for us. So I was concerned about being able to get the conflict waived by the City of Los Angeles in time, or even if they would. They'd probably have to move heaven and earth to get a conflict waiver from the City of Los Angeles, you might imagine. The lawsuit's been filed in the Kern County Superior Court up in Bakersfield. And so we sort of made a judgment call that the smart thing to do would be to get that matter, which I think should be a small matter, easily handled, into the hands of a firm in Bakersfield, which right there can appear in court easily and hopefully inexpensively. And so we contacted them and lined them up. And so they're going to take care of that matter, I think, What it is it involves a total of 0.164 acres, so it's not very much property. The value that they've pleaded in the value of the property to be taken, they say is $300. It should be worth a whole lot more than that if they were to take it directly. Really what they should be getting in lieu of, they obviously need to cross. You can't relocate your entire project, but really what they should be getting from you is an easement and not the fee interest. And you don't even fee, they don't get the benefit of the presumption of the more necessary public use because your public use is important as well. As I understand it, you have a 36-inch diameter pipeline there. It's a raw water pipeline that takes raw water to the rosamond treatment plant. So that's even more important for you than it is for them. An easement over the top of that should be sufficient for them, and that's what they should be getting. So I think it's going to be a case of filing an answer and talking to them and getting it resolved through the conveyance of the easement. That's what I think should happen. We can't do that. So hopefully that's an inexpensive solution to that problem.
How much time do we have to file?
You've got a 30-day period, and it was served on August 7th, so there's just a little less than 2 weeks left to do it. And ship the paper to file an answer. And so I've shipped the paperwork off to Young and Woodbridge, Kern in Bakersfield. They represent a lot of public agencies. They do condemnation work. They're capable. I've talked to them. They had some conflict issues themselves that they had to check to make sure they weren't running into a problem. They're not. They said they can do it. So we've shipped it up to them, and they're happy to be able to help the agency.
Who's going to ensure that this happens?
They will be your lawyers on that matter, so it would be malpractice for them not to file an answer.
You feel comfortable with that, Rob?
Yeah, I talked to Dan today, we reviewed the conflict waiver. We signed it.
Okay, we'll sign it.
Yeah, so there are lawyers now. I agree with Mike. We're spending public funds to an attorney, and that's paid public funds to attorney on something that we would have, like, we just agreed to have done.
Yeah, it's not clear to me. They're actually required to make an offer and negotiate in good faith, so it's, I'll have to find out. The firm representative will have to find out whether that happened, and if it didn't happen, why it didn't happen. If they did not make an offer and negotiate in good faith, that would be a very big problem. Great incentive for the city to settle, because that would be a killer for the case, because they're required by law to do that.
It seems we should, it's going to cost us eventually several $1,000s to just respond and do this. It seems another waste of public money that a public agency is causing another public agency. We should look for the source of it so it doesn't happen to us again or other agencies. Track it down and find out why we're doing it. I'd rather spend time, effort, and money doing that than just responding and acting like
Agreed.
I don't know, again, if it's another letter to,
With the lawsuit filed by some school districts in Kern County that were challenging the methodology used on behalf of some redevelopment agencies, successor entities, and the way they were calculating the distributions of tax revenues. And the named defendant in that lawsuit was the auditor controller for Kern County, because that's the office that is doing the calculation and dispersing the funds on behalf of a whole bunch of successor entities that once were redevelopment agencies. The lawsuit named a whole bunch of real parties in interest, including AVEK and a number of other taxing entities that were getting tax distributions as part of the wind down. And so AVEK was named undoubtedly because they saw that AVEK was one of the entities getting a tax distribution. There are a number of city redevelopment agencies, successor agencies, that were involved in the lawsuit. One of them was California City, and you'd be getting money from as a result of the California City interest. I was concerned about it because it was hard for me to try to calculate how much might be at stake. And plus, I need to learn a little bit more about how the process works. I talked to someone in our office who has a lot of experience with this thing, and apparently there's a lot of these lawsuits. There was a case in which some school districts sued another county for their calculation, and the court ruled in favor of the school districts, and apparently that same methodology is duplicated in lots of different places. And so it's spurred a flurry of these kinds of lawsuits by school districts. And the way it works, however, is that apparently it's typical to sue the county auditor controller. Sometimes they name real parties in interest on the theory that it could affect how much money you get, AVEK would get from distributions in the future. I asked whether it had ever been the case that upon a successful result that they would actually reach into the pockets of the public entities that had received distributions in the past and pull money back. In other words, you have to get back some of what you got before. The answer to that is no. The way it's always done is that if there's an adjustment to be made, then they take it out of future distributions that would be coming to AVEK. But here's the way it works. When you have a pass-through agreement like you do, then what the successor agency does is it pays that first. The pass-through money gets paid first. Then the next on the list of obligations would be if there are contractual obligations that the successor entity has to pay. For example, if there's debt service on bonds that were issued, or you have to pay off some contractor, that gets paid next. So first is the pass-through, the money that you should be getting. Next is the contractual obligations. And then the third is the money that's left over, and that's what gets distributed to the taxing entities. So if there's an adjustment to be made, it would be made out of that third pot. I think you're actually getting paid out of the first pot because you have a pass-through agreement. I also asked our attorney, who's very familiar with these, whether it's ever the case that a real party in interest files an answer in these cases. He says no, he's never seen that. Real parties in interest typically don't do that. There's a couple of reasons for that. One of them is that if the court were to rule in favor of the plaintiffs, it still would have to be approved by the State Department of Finance. And they sort of act like a watchdog to make sure that the calculations are being performed correctly. So they basically are there to protect you, the State Department of Finance. So the question I was grappling with was whether or not you had a lot at stake that you would risk by not filing an answer. And it looks like the answer to that question is no. And so my suggestion would be, given the limited potential exposure that you would have, that it's not worth spending the money on lawyers to try to dig into it. Spend more money on legal fees, but it probably make no difference whatsoever. So my suggestion would be just not to do it. Apparently they never file a request for default against real parties in interest, and you've got a state agency there as a watchdog to make sure the calculations are being performed correctly. So I think you're
Right. Item 11, old business, possible closed session. 11A, Dan, are we going to be meeting closed session?
I think Mr. Brunick was available by phone if the board wanted to talk to him, but I don't know if he had an update for us at all. So, unless the directors want to talk with him, I don't know if this should go to the closed session.
Probably should go into short closed session. Issues.
Okay, do I have a motion?
Second.
Do update on.
I'll be recusing myself from this item. George, will you do the same?
George, are you still there?
Yeah.
Frank, are you on?
Yeah, I'm here.
Okay.
Okay, roll call vote, please.
Shelley Sourcewell.
Yes.
Keith Dyas.
Yes.
Frank Donato.
Yes.
George Lane. Robert Paris.
Yes.
Marlon Barnes.
Yes.
Ian Weisberg.
Yes. Carried. Okay, we'll go into closed session after a 5-minute break.
So in your package, we have a suggested fee schedule which would increase the fees $5 for each one of those one of those tests that's in there. And we would like to give customers 60 days notice. We want to make this effective in a couple of months so that they have some notice on it. And the committee also asked that we take a look at this every year or so just to see how we're tracking on our costs. So staff recommendation is we adopt the fee schedule that's in your package.
I'll move on board with 6.
Second.
The allocation is at 20%, Oroville's at 46% historical average, and San Luis is 45%. You'll notice on the next couple of charts, they're really low, but they are at 45 and 46%. Oh, that's the marina at Oroville. In fact, I have one picture where they're actually rappelling down to get to their boats. They have like ropes so that they can get down the side of the hill to get down to their boats. Here's the northern Sierra precipitation. Again, you can see the dark blue line is this year's precipitation, about 75%. So we're looking at 36 inches. Reservoir conditions, you can see the blue is the actual storage. The red numbers are the historical average. So Oroville is 46 and San Luis is at 45. You can see the San Luis capacity number is like 20%. Getting down pretty low, which you would expect, well, at least San Luis this time of year, that we're going to be again about where we were at the end of last year. And again, here's Oroville storage. The dark blue line is the actual storage. You can see where we were in October last year. So we're just about where we were in October last year. Here's San Luis. Last board meeting I discussed how the bureau is getting really, really tight, and they're kind of borrowing water from the Department of Water Resources. The Department of Water Resources assures us that they're going to get the water back before the end of the year. So the dark blue is the state water project share, and so we still have water in San Luis that we have available to us. Operations. These numbers are up just a little bit. Quartzville is at 25 MGD, Rosamond's at 8, East Side 2.5. Palmdale connection we just mentioned is 1 MGD. And then our groundwater extractions, we have East Side. We've actually, today, we started pumping in, I guess it was about 2,100 gallons per minute, but we have 2 wells that are now pumping into the aqueduct, so we'll be storing that water in the state water project system to have available either this year or early next year. So that's another success story. We've got some more wells online. We're continuing to do the 96th Street well, and then West Side again is pumping at 12 MGD. I don't know, John, any other comments there? Groundwater pumping again at 96th Street. We're still continuing at 13. We've been chugging along on 1,300 MGD on that. West Side is at 12, and that's going to 80th and H. I don't know if is that pretty much driven by demand? And again, we started this week on East Well, actually started today, the East Side wells. Yeah, it is. It's good news. Continuing to increase our capability.
That's just one well on each side or 2?
That's 2 wells. And the number is actually, I guess this one is like 2,100 or so. But that means over there on the east side, we've got the 1,300 MGD and 2,100 that got the new wells. Water quality remains good. We do have some algae that's kind of breaking loose this time of year where you kind of expect that in the canal. So the screens get clogged up and so forth, but it's not something we can't deal with. We did do some in-house THM sampling, and the results are very good. We're still meeting our goal. I think the only area is concerned is Lake LA. A lot of it is you have to manage the system. You have to run water through the system. We started, I think I mentioned to the board, the Acton or Yeah, the Vincent tank we were getting a little high in the Vincent tank. We encouraged the county to run some water through it, and it helped bring the numbers down. The water quality is remaining good. State Water Project, I do have a meeting on an exchange and storage program with Metropolitan on Thursday. They did put some bullet points together and we briefed the board, and I think it looks very promising. Looks like we have an opportunity next year's wet to actually get some water stored or get some water exchanged.
I know. They have some fun words.
That's another thing. So, we do have our strategic plan workshop coming up on the 3rd. We did send a letter, the board, at the last board meeting, we discussed the transformer issue. We did send a letter to Edison, they did call back. I'm not sure if we want to go to a committee or if you want me to work with Edison or in-house, or how the board would like to handle any conversation we have with Edison.
Well, you can start it, and if you think you need the help of the board or the committee, you know.
Okay, that's fine.
So they did call back?
Yes, they did.
Yeah, who called back? I mean, at what level?
It was Carrie Gardner. I don't know what level she is. It sounded like she was the public relations person locally, so it wasn't the CEO.
Wasn't that?
Mr. President, participated in that.
Just wondering. We'll have to work our way.
And I would like to participate.
Okay.
One will be the
My schedule, I'm out on Friday, but I'm in next week. And that concludes my report.
Projects you want to mention that we're out to bid now on 2 projects. One of them will get the rebid on the SNF Phase 2 pump station. Seemed to have pretty good feedback from contractors, some of the same ones that did before. Or we actually got a couple new ones, at least got specs out, so we'll see how it goes. So we may have at least equal as far as the number of bidders on that. The 4 million gallon tank that's going to go in on the west side banking project, that's out to bid also. It's coming sometime around the middle of next month. So there's only a few contractors that build tanks, so we usually get about 3 bids on that. So go from there on that one. See, as we get down through these items, D2, which is the Avenue H Wellfield Bench Ranch, or pipeline pretty much into the ground. As far as the purchases, Nicola's still working on the equipping the well and getting the buildings up. If you want to bring up Yellow Jacket well drilling, they were the contractor that drilled the wells. We would recommend that the board accept that project as complete. They're done with the wells, the drilling of it, not Nicholas is doing the well equipping, so we recommend that the board accept that as complete. Then the notice of completion could be filed for that.
That's D2.
Yeah, D2.
On D2, say the Yellow Jacket is completed in the project. Follow notice of completion.
Rob? Okay. Any more discussion? We have a roll call vote.
DWR has put in the previous work, which was done, which was a slot in the aqueduct that was never shown in the drawings. No one knew about it. And so when he bid it, he didn't have that in his bid, so there was $1,519 on the labor for that. We kept track of the amount of effort, so that checked out okay. Item 2 was an item to extend the pipe that DWR put in. They put in not only the slot in the aqueduct, they put pipe through the embankment and over to the right of way. Except they were 7 feet short, and this is something that really came up from Tahone Ranch looking at it and said, hey, we need to have this pipe extend into our property. So this brings the 24-inch pipe into their right of way, it's 15 feet. And this way, we have Hobbs do it under this contract. DWR doesn't have to get a new or a DWR, but Tahone Ranch doesn't have to go to DWR to get a new permit beyond their property. So it saves them some time and money and the amount to do that, because they do have to order 15 feet of steel pipe. And also we have a fiber optic cable that's right at the property line that the contractor has to deal with also. So that amount is $27,885. So we did get a confirming email from John Ranch saying that they were happy with this, and so they agreed to this change order, because we don't want to have you approve it and they don't want to pay for it, because this is all going to be paid by John Ranch. So they are in agreement with this change order. So we recommend approval.
We're going to change your year to Hogs Construction for 29/404/99 in 23 days.
I'll also mention that the Water Projects Committee reviewed the change order and recommended approval. Are there any questions or discussion? Roll call vote, please.
Shelley Sorsable?
Yes.
Keith Dyas?
Yes.
Frank Donato? George Lane?
Yes.
Robert Paris?
Yes.
Marlon Barnes?
Yes.
Neil Weisenberger?
Yes.
Would this be a good time to go back to the PFM report?
Carl's giving me the thumbs up, so Ms. Carlos and Sarah can give us
I think it only goes to the phone.
I know.
No.
Just letting Georgia know.
Oh, okay.
We also had our chief investment officer write a short memo to all of our clients yesterday that Dan and Teresa received by email, but I wanted, since this meeting was so timely with what's been going on in the markets, I brought extra copies of this and I'll hand those out as well. And Carlos can get started.
I'm pulling my phone out because I'm going to give you some data, and then I'm going to update it with what we've seen through the past couple of days. Simply because the past couple of days looks a lot like 2008. If you remember those balmy days in the summer of 2008 when WAMU shut down and Bear Stearns was bought out, and the government took over Fannie Mae and Freddie Mac. And you may recall back in that further as it progressed to 2008 and early 2009, we just saw a credit crisis and the markets really seize up. Well, the stock markets in the last couple of days felt like that, but today is very different. And the problems that we're seeing in the markets are not related to what we saw back in 2008, and that's the good news. The bad news is that we do have that volatility, and most of that volatility is driven by investor concern with what is happening in China and Japan and on a global basis. And that's what's really driving the markets today. The bottom line is that the events of the markets that we've seen in the past few days has not had a negative effect on your portfolios. If anything, it has driven yields down lower, which has made your current investments appreciate in value. So I just want you to keep that in mind. And indeed, the memo that Sarah handed out speaks to that effect, that we don't see a reason to change our strategy, because if you recall, you are in local government and you are subject to California government code, and that effectively means that you purchase bonds. That's what you buy, high quality, short duration bonds, shorter than 5 years, in a well-diversified portfolio. Let's take a look real quickly at what we have here. So do I?
No, that's not.
Oh,
It's just my
okay. And it's,
You
to
turn
just
it off.
press it to agree.
there it goes. Okay, so if we could just forward to tab number 1. Thank you so much.
Too much technology at once.
It is too much technology, but that's okay. So what you're looking at is what yields in the 2-year range, and you're currently invested on average slightly shorter than that, but this is what.
Frank, are you on the line?
Yes, I am.
Oh, thank you. Frank has just joined us. PFM, we held off on their item until you got on the line, so they just got started.
Okay, thanks.
Excellent. So looking at page number 1, this is what yields did over the past quarter. This is the yield for 2-year investments. And you can see that two observations. They were volatile, they moved up and down. A lot of it was mixed economic releases, not mixed, you had some positive economic releases, and then uncertainty as to when the Federal Reserve was getting ready to raise the federal funds target rate, that short-term rate that drives yields in the short end of the yield curve. Then if we take a look at the next page, the real interesting bit here is what happened with yields over the past, basically over the past quarter. If you can see that yields actually from the last 3 months have risen, particularly in the longer maturities. So you can see that, you know, anything beyond a year or longer, it went up. The 2-year went up 9 basis points. The three-year treasuries, the yield for 3-year treasuries went up 12 basis points. 5-year up 28 basis points. So just to give you an idea, so you can see where yields ended up. They rose, which caused your portfolio to give up some value. So I'm going to update those numbers, some of those numbers for you to give you an idea of where we are today. This was as of June 30th. Well, as of the close of business today, the yield for 2-year investments, which as of June were 65 basis points, ended up at 59. That's a rally. That means that those bonds went up in value. In the 5-year range, back in June, those ended up at 1.65. As of the close of business today, went down to 141. Again, that's a rally. Looking at the 10-year yield, you don't invest in 10-year, but it's a good indicator for where the rest of the economy of how it's doing. That ended up at 235 at the end of the quarter. When you look at where that ended up today, it ended up at 207. So you can see those yields falling. When yields fall in the bond markets, that's a rally. Those investments that you currently hold in your portfolio go up in value. And the longer investments go up in value more than the shorter maturity investments. And that's just an interesting phenomenon. Why did yields fall? Simply because investors get very nervous about, or have gotten very nervous about growth prospects in China, the growth of the European economy, and uncertainty about Japan, but in particular about China. So when they get nervous about those types of investments, they get nervous on risky investments, they sell out of those investments, which again causes those stocks to take a tumble, and they move to the safety of treasuries, which is what I'm showing you here. When they buy those treasuries, they push the price up because of increased demand, which makes their yields plummet, which makes them go down.
Another question, do they get nervous about the economy of pretty much any country that starts going down?
No, the answer is no. And to your point, when Greece came back and had their referendum as to whether they were going to implement austerity measures, honestly, yes, some investors got nervous about it, and the markets moved a little bit, but it was a blip in the screen because Greece, as an economy, is a very small economy. It really doesn't move in global markets. China is now the second largest economy on the planet. And China has a real estate bubble. They have full cities they've built, hoping that they would be filled with increased consumer demand, and they weren't. It's a bubble. China is starting the beginnings of a credit problem. These are banks that overextended making loans, which are not likely to get repaid because people aren't earning enough to be able to make it back. China has the engine of their economy. That which drives their economy and creates value are exports and manufacturing. Really the exports of the manufacturing. This is all the products that we buy from them. And that has slowed down. So they've taken some steps. Last week or a week and a half ago, they devalued their currency. That generally makes their exports cheaper. I think they did that twice. They have lowered their key lending rate to stimulate the economy, to make more credit available, to accelerate the speed of money changing hands. But the biggest obstacle, what we've seen in the last few weeks, is we saw a 30% tumble in their stock market, and then followed by increased or continued step backs in their stock markets. And indeed, over the weekend, investors got, on a global basis, got very nervous, and they started pulling out. And that's what affected our stock markets here.